That happens on a fairly regular basis with my wheel trades. Now, again, my plan had been to hold the stock regardless. So, in a sense, the stock leg losing, because if the stock gap's lower and I lose on the stock portion of this, it doesn't really factor into this part of the decision-making process. It is a long-term hold for me. I'm not going to worry about short-term drawdowns in it. If the stock goes up, the strike price is going to serve as an easily identifiable line in the sand to trigger closing or rolling that call.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 73, my exact process for covered calls. But before we jump in today, I again want to thank the many listeners who purchased my new book, Build Consistent Wealth with Options. If you haven't, I know I'm biased, but I think you should. There's a lot of great stuff in there, some that we covered on this podcast, and even more. If you have purchased the book, please leave a review on the online store at which you bought it. Today, we're going to talk about a covered call trade that I'd done in the past. It was one cog in one cycle of a long wheel trade in Amazon. This particular covered call was one that I had the skate objective on. And again, the skate objective just means I wanted the premium and did not want to get assigned and lose my stock. For this trade and others like it, I use a special tool that I developed. So before we get into the specific trade, it would be helpful for me to share how that tool works. I briefly mentioned it on the show before. I'm talking about the PAS indicator, or PAS bands. A while back, before I wrote Build Consistent Wealth with Options, I was looking at a chart, trying to find an indicator I could use as an anchor to set a strike for a skate wheel trade to reduce the risk of assignment. I had always used support when selling puts and resistance when selling calls for this purpose, and I still do. But I wanted to further increase my odds of skating. There had to be another technical tool, right? Another indicator on the chart, another lower indicator, something. I mean, there's like 400 different studies on Thinkorswim's charting platform. Seriously, I counted them. One of those has got to do the trick of finding good option strikes to sell. But no, it turns out that not one of them was really built for helping wheel traders pick strikes. Not a one. So what the heck was I supposed to do? Well, I did the only thing I knew how to do. Figure out something I don't yet know how to do. I created my own indicator. And I borrowed some concepts from other indicators. I reconfigured some of the math to account for specific holding periods, added a haircut to adjust for risk tolerance, little other nuances here and there, and I got it working. And it works great. I call it the price history anchored strike indicator, or simply the PAS indicator. The PAS indicator is designed to cut through the guesswork of option strike selection. Instead of pulling levels out of thin air, it anchors each decision to a stock's actual historical price range over a defined look-back period. By grounding strikes in price history, PAS gives traders a data-driven edge, highlighting levels where probability, premium, and price action intersect. It's the first indicator ever created by an option trader for option traders. Basically, what it does is it finds the true range of a stock over a period of time coinciding with the number of trading days to expiration and it smooths it with the moving average. Then it puts a band above the chart by the value of the range and below the chart by the value of that range. And I can further alter it, that value of each of the bands, by using the haircut that I mentioned before. I typically use 75% of the haircut. So that's 75% of that range. The idea is if you set the covered call strike at or above the upper PAS band, you are more likely to skate on the call than you would be with many of the other criteria that people commonly use that don't really have anything to do with how the stock tends to act in the real world. The PAS bands are grounded in real price action, real data. And likewise, if you set your cash secured put strike at or below the lower PAS band, you're more likely to skate on the put than using some arbitrary method. And this is one of the tools that I used on this trade that we're going to talk about today. If you want to get more information on PAS bands, I have a webpage that shares everything you need. Visit buildconsistentwealthwithoptions.com/indicators. That's just the title of the book. buildconsistentwealthwithoptions.com/indicators and check it out. Note to our show producers, let's add a link in the show notes to buildconsistentwealthwithoptions.com/indicators. Note to listeners, presuming our producer took notice of the previous note, there will be a link to the page in the show notes. This is a case study in Amazon.com covered calls. Amazon is a stock that I owned while writing the book, and I'd actually owned it for quite some time before then. It was one of the Magnificent Seven stocks that contributed disproportionately to the S&P 500's gain for some time now. While its valuation was hardly cheap at 34.6 of a PE ratio, it was a stock I planned to hold on to. I had no interest in selling it. It's also one that I systematically wrote covered calls on over and over and over, cycle after cycle after cycle. Now, during the period of time that I was looking at Amazon, there wasn't an X date for the dividend during the life of a potential option trade. So temporarily losing it and having to wheel into cash secured puts wouldn't be a huge deal. But either way, the objective was to skate. At that point, Amazon was trading in a channel for the past 4 months, with support at $210 and resistance at $235, and then even more resistance up at $238 a share. The price history anchored strike indicator, or the PAS indicator's upper band, was at $240.07. I was using a length of 10 trading days for the true range and a smoothing period also of 10. And in this case, I actually used a 65% haircut. The PAS upper band shows a level that should be out of reach for the stock to hit over the next 14 calendar days, which is 10 trading days in this case, based on the recent range set by the true range length parameter. So the PAS indicator provides essentially an extra resistance area, if you think about it, right? Going out to the October 24th expiration that would expire 14 days later to coincide with the PAS indicator settings, the 240 calls were $1.39 bid with a pretty tight and liquid bid-ask spread. The annualized static return for that trade would have been 16%. This trade candidate forms a good starting point for a skate objective covered call to sell against shares in inventory. But hey, you know what? you got to shop it around. We've got to look at other choices for this, other expirations, maybe even other strikes. Going out to the October 17th expiration, which would expire in 7 days, that only had a bid of 52 cents on the 240 strike calls. But going to a shorter time period till expiration, well, that might mean being able to sell a lower strike, and maybe there's less time for the stock to move. Well, there's half the time for the stock to move, right? The 109 bid for the 235 strike calls in that expiration looked pretty reasonable at first glance. 3.5% out of the money for a week, not so bad. It's reasonable, but hey, maybe the 237.5 calls at 74 cents are the Goldilocks play. Out of the money by 4.6%, that adds a higher degree of safety. Although that strike is lower than the second level resistance that I mentioned before, $238, that's the farther out resistance. Well, reconfiguring the settings on the PAS indicator to a length of 5 trading days for this 7 calendar day trade, and I kept the 10-day smoothing period, that puts the upper PAS band at 237.44. So that's perfect for this strike. It's just south of the 237.5 strike. The implied volatility for the October 17th 237.5 calls was 28.44%. Now, that vol was lower than the October 24th 240 calls, which was 29.38%. But, I mean, it was just 1 point below. Both of these implied volatilities, 28.44 and 29.38, they both look pretty good against the historical volatility at the time, which was sitting at just 18.9%. Earnings weren't until after the market close on October 30th, and so that made the October 31st expiration, a little more challenging to rally around for selling options on, right? We want to avoid that earnings date if we can, usually. So the next thing I did is I looked at the thetas and I compared them. The October 24th 240 calls had a theta of 12.9 cents a day. And the other candidate thus far, the October 17th 237.5 calls, had a theta of 14.5 cents. So, it was somewhat better for the shorter term calls, which one might expect when we're not too far away from the money. Specifically, the theta was like 1.5 cents higher for those 1 week 237.5 calls. So the next thing I did is I calculated the annualized static return for each of these. The October 24th 240 calls had an annualized static return of 16%. That's the 2 week ones. And then the October 17th 237.5 calls, that's the 1 week ones, they had an annualized static return that was just slightly higher, 1 point higher at 17%. So these two choices, they're pretty neck and neck. Sometimes when I do all these calculations and do all this analysis I'm talking about, sometimes there's a clear and obvious winner. But here, it's a pretty slight margin, with most of the data favoring the 7-day calls by just a smidge. Another factor that might tip the scales on this one is the fact that in this liquid name, I would definitely plan to buy the calls back as part of a roll at some point in the future. Once the call sale hits and is executed, goes through, as soon as I got that short call on, I would enter my 3-cent good till cancel limit bid. So to split hairs just a little bit, really, I'd hope to make 71 cents selling these calls. That's the 74 cents that I could sell them for minus the 3 cents that I'd buy them back. So really, the annualized static return is more like 16.3% on those 7-day calls. And if I do the same thing with the 2-week calls, it's $1.36 is where I can sell them, minus the 3 cents that I'd probably buy them back. That's 16.6% on the 14-day ones. So not really too big of a deal. And you want to like split the split hair? Well, I guess if we do the 1-week ones, I might have to pay commissions twice because I'm going to keep this wheel going. So if I sell a 1-week and then sell another 1-week, there's 2 commissions. If I sell just 1 2-week, then that's just 1 commission. But hey, some brokerages don't even have commissions, and they're pretty darn small anyway. So in this example, I ended up picking the October 24th 240 calls. The bid-ask spread was just 2 cents wide. Don't you just love that? And there was 14,452 contracts of open interest. So it's liquid enough to be worth trying to middle, notwithstanding the fact that it's still only 2 cents wide, so it's not a big deal. We're talking about a penny. And, as long as the underlying is not moving much at execution time, I might try and middle it. But if I didn't get filled immediately after entering the 140 offer, the risk of the stock moving lower and thus the bid for the call moving lower, it's too big of a deal to wait and hope for a fill. So in situations like this, and in this situation, I just enter the mid-market offer. If I don't get filled, step down a penny and just hit the bid, knock it out, get it done. I want the position, not the penny. Once the trade's on, the next step is what? What is it? Yeah, that's right. It's to put the plan into motion. Once filled on the sell to open offer, like I mentioned, I would immediately enter that 3 cent good till cancel limit bid. And knowing full well that I might end up canceling that 3 cent good till cancel bid at some point in the future and rolling it at maybe some other price. I mean, look, it's super liquid, 2 cents wide. So that makes rolling not just possible, but pretty likely to be very easy to get a decent price on a roll without giving up much edge at all. But nonetheless, I do enter the good till cancel order anyway, just in case, like maybe the stock gaps lower and I can buy to close the trade and take the lion's share of the profit early. Why not, right? That happens on a fairly regular basis with my wheel trades. Now, again, my plan had been to hold the stock regardless. So in a sense, the stock leg losing, because if the stock gap's lower and I lose on the stock portion of this, it doesn't really factor into this part of the decision-making process. It is a long-term hold for me. I'm not going to worry about short-term drawdowns in it. If the stock goes up, the strike price is going to serve as an easily identifiable line in the sand to trigger closing or rolling that call. I tend to wait for confirmation candles on these. Like if it just touches the strike price, I don't go, oh my God, I got to roll right now. I usually wait a day and see if it closes above the strike one day and then is trading above the strike the next day. That next day is my confirmation candle. Now, in this case, there were quite a few inflection points to connect horizontally above the 240 zone on the chart. That means get more resistance. On a lot of stocks, an active covered call trader would opt to buy to close the call once the strike price has been crossed and confirmed. And I do sometimes too. But I've taken a passive approach to the wheel with Amazon over the years. And that's true for a good handful of other stocks that I own as well. Just this passive approach where I always keep the wheel on without really digging into the implied volatility so much. And also part of my passive approach, I don't really worry too much or take into account so much the resistance too much either. I mean, I try and set my strikes above resistance and above the PAS band, but I think it'll just continue going up over time. And so there's nothing really holding the price down in terms of past evidence, except for some of these slight resistance areas. But I'm going to make the trade regardless, in a lot of cases anyway. So, okay, how does earnings fit into this passive management? Well, earnings, and again, in this trade example, it was on October 30th, so before expiration. Sometimes with active wheel traders, I mean, that would be a reason to sit that cog out. But passive wheel traders, or anyway, I'm both. Sometimes I'm active, sometimes I'm passive. In this case, as a passive wheel trader in this stock, once it comes time to roll, which would be on or before the expiration date of October 24th, again, before expiration, I would just roll. And that expiration, the next one, at this time, I think Amazon still only had weeklies, not the every other day ones like they have now. So I would roll out a week. I would roll to the October 31st expiration, which is one day after earnings. And I'm okay with that in this case. So then which strike would I roll out to? Well, I look at previous earnings gaps. I still take into account earnings, but I'm willing to hold a trade through earnings. So what I do is I look at previous earnings gaps to see how much Amazon tended to gap upon the earnings announcement. In this case, for the past 7 earnings announcements, the biggest earnings gap, which the way I measure it is by the price that the stock closes the session before earnings compared with the opening price immediately following earnings. Well, in this case, the biggest gap was 9.6%. The second biggest gap was 7.3%. Because I have the skate objective, wherever the stock price is at the time, in a perfect world, I'd want to sell a strike at least, 9.6% higher, right? If I'm going to hold it through earnings and the biggest gap was 9.6%, if I sell it 9.6% above where the stock is, well, then I have another thing that I can feel more confident in the trade about. But what about between now and expiration? I mean, if I'm rolling on the 24th, the stock price can fluctuate between October 24th and October 30th, earnings day. So, that's kind of the rub. I know what the price is on the 24th, the day that I have to roll, but I don't know what it's going to be on October 30th. And I want it to be 9.6% higher than the price is on October 30th. That's 6 calendar days and 4 trading days away. And I can have price variation between now and then. So obviously, it's impossible to predict whether we get variations up or variations down or up and down price action trending one way or the other. So the best way to think about it is if you want to think about it like game theory here, you would think statistically, think of the distribution curve. So I would sell 9.6% above the stock price on that date because the highest point on the curve, especially just 7 days away, meaning the most likely scenario for the stock to be 7 days away, is where it is now. And obviously, it's not going to be exactly where it is now, but that's what the distribution curve tells us is the most likely scenario. Statistics, they're interesting, right? So one thing that I know is that it's common for options to become overpriced leading up to earnings. And I'm not saying just that their implied volatility goes up leading into earnings, but a lot of times it goes up more than it should, and options get overpriced. So the risk of selling options that carry increased skate risk because we're going into earnings, a lot of times is overly compensated by those inflated premiums, overpriced option premiums. So really, even though there's more risk, there's more edge. And probably if you balance out and look at the amount that the risk increases versus the amount the edge increases, the amount the edge increases is going to be even better. So basically, we're looking at a trade with a higher Sharpe ratio, if you want to, think about it as a mathematician type way to think about it. But I've never actually done a study on that, but that's the logic behind this trade. So that is how I trade skate trades for covered calls, just from start to finish. That's pretty much my whole logic process. We're going to do a couple more of these trades in upcoming podcast episodes. So stay tuned. We're kind of taking everything that we've talked about over the last year and a half or whatever it's been. Holy cow. It's been a while since I started this, huh? And we're kind of putting it all together. So this is kind of the exciting episodes, really. And that about wraps it up for this show. Don't forget that if the PAS bands is something that you're interested, go to that webpage that we put in the show notes, or once again, that's buildconsistentwealthwithoptions.com/indicators. buildconsistentwealthwithoptions.com/indicators. And everything you need for PAS bands is on that page. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.